Welcome back to Indianomics. This is a bond market special, and our guest is the last word on these markets, Shyamala Gopinath, the RBI Deputy Governor in charge of markets. Mrs. Gopinath, really, we come back to that charge. The corporate bond markets are not growing as fast as all people interested in it wanted to grow. RBI included, the government. Just what is holding it back?
I do agree that the corporate bond market has not developed the way one would like to, and in fact it has become the holy grail for all policymakers, whether it's RBI, SEBI and the government. Firstly, I'd just like to clarify that the corporate bond market, the regulation and of the primary and the secondary market is with SEBI, because there is a feeling that there are regulatory overlaps. That's not the case, except for repo in corporate bonds, repo being a short-term market. The regulation is with the Reserve Bank of India. But yes, we all financial sector regulators have an important and a critical role to catalyze the corporate bond market because of its major role in financing long-term projects. One thing I want to just dispel a notion about the secondary market activity in corporate bonds. I was just looking at some data that is published by this Securities Industry Market Futures Association. And I found that the secondary market activity in the US, which is the most liquid, deep markets, in government bonds it is about $500 billion. Oh. In agency securities it's about $300 billion. And the corporate bonds it is $18 billion. So okay. I think one has to have some kind of a more nuanced perspective on the whole issue of secondary market activity in corporate bonds. Of course, one reason for the slow corporate bond market development has been the very positive role played by the banks in terms of intermediation. But even otherwise, if corporate bond market has to develop, we need to deal with both the supply and the demand side issues.
Okay. What you're saying is that there isn't enough demand by way of investors. You mean insurance companies, pension funds? Is that the main thing that's holding back?
No, there is a demand from insurance players and pension funds investors, but their demand is for a certain quality of bonds. Okay. For instance, they are interested in long term, no doubt. They are credit risk averse, yes. So they are interested in highly rated bonds, and therefore you find that the supply of bonds also are issued to meet their own requirements, and therefore you find the corporate bond market dominated by issuers such as banks, financial institutions, public sector entities. They're all rated well and high, and the investors have great confidence. And on the other supply side issue is really that the large corporate players, which can easily issue AAA rated bonds or even AA rated bonds, are accessing overseas markets. Okay. So they prefer to access the overseas markets rather than raise funds in India for obvious reasons.
Yeah, so the category that is not coming into the market perhaps is the BBB, just less than the best. Now, one way to work one's way out of this could be credit default swaps. What is your own timetable? Do you think that we will see that market before 2010 is out?
Yes. In fact, the credit default swaps has come in for a whole lot of reforms even internationally. There are even questions being raised as on whether it's a socially useful product or not. But clearly that's not the case with the plain vanilla credit default swaps. They have a very important role to play in ensuring the development of the corporate bond market itself, because the existence of this instrument will actually promote liquidity in corporate bonds. So this is very much on our agenda, and we have already looked at international practices, and I'm positive that we will have the draft report placed for public comments in July, and we will introduce this product initially maybe through the OTC market with a reporting platform, and then I think we should be going forward to improve the market structure.
Okay, so you're expecting that before 2010 calendar is out, we should be able to get credit default swaps.
Yes.
All right. On the other issue of interest rate futures, that is the other big announcement that came in the credit policy, that the shorter term interest rate futures will also be introduced. Now, the one that is already trading has been quite a disaster, and this is the second time around that we have an interest rate futures product, and it's simply not taking off. So will you consider cash settled at all?
Well, just let me give you some perspective on this. The 2003 product that we had, the interest futures product, was cash settled, and it didn't take off. So I think one has to look beyond that. And we have this technical advisory committee on forex markets. There was a working group that was set up by that committee, which included not only the Reserve Bank of India, but also other market players, industry associations, SEBI, and academics. And this particular group recommended physical settlement of not only the 10-year, but also other products along the yield curve, and a 91-day T-bill futures cash settle. Of course, they recommended a calibrated way of introducing these products. We selected the 10-year IRF because that was the segment of the yield curve that was most liquid, and we have a large supply of deliverable securities. But true that the market has not taken off for certain reasons, which I can explain separately. But one thing we need to be very clear is that we have to operate within a certain macro economic framework, and financial stability is clearly our objective. I mean, whatever products we introduce, we need to have the financial stability objective. And within that, we are willing, more than willing, to introduce new products. And that is why, even though the 10-year has not taken off, we are willing to introduce new products like 2-year, 5-year, and the 91-day Treasury bill futures.
What will be the timetable? Will it be first 91-day and then the 2-year and 5-year? What is the plan as of now?
Actually, we are quite flexible. Certainly, 91-day T-bill futures can be introduced, in a shorter time frame, because we do have 91-day issuances of treasury bills every week, and there's clearly a benchmark price, and that is something that can take off sooner than later. And the 2-year, 5-year also will follow. So it's not as if we are going to be really doing it in a certain time frame. We would like to have all the products on board.
Okay, so you expect that should happen in a quarter or so?
Yes.
But what about cash settled itself? I mean, there is still that audience for the 10-year, or rather, market for the 10-year. Will that be at all introduced? You spoke about macroeconomic stability being the main concern. How will that impact at all? Why is that cash settled feared as possibly harming the system?
No, it's not just the cash settled is an issue for macroeconomic stability. See, let's look at the financial markets overseas. In all the developed markets where you have interest rate derivatives, they're all physical delivery. They're all physical settlement, because the futures prices have to have a connect with the cash price. They cannot be at variance. Then the product does not fulfill a basic need of the markets, and that is hedging. If you're saying you want interest rate futures market for hedging, then you have to have that connect between the futures price and the cash price.
Before I go into a break, one philosophical question. You sound very eager to introduce this entire menu of products. Why wasn't this done, say, maybe 3, 4, 5 years earlier? A lot of the learning and the trepidation would perhaps have been advanced, and we perhaps would be sitting at a more developed situation now. Why this delay, ma'am?
Traditionally in every market, it has been the OTC that has developed first as far as the interest rate products are concerned, and the currency. Even today, the volumes in the OTC forex markets, whether it's forwards or options or swaps, are all mainly OTC. And there are exchange traded products, but clearly it is the OTC. And it's very important to have a well-developed OTC market to supplement derivatives markets. And it's not that we didn't do anything. We have been introducing new products, and one constraint that we've had in respect of currency has been that we're not fully convertible on capital account. And clearly it would not have been the opportune time to introduce currency derivatives market when we had a whole lot of regulations on the forex. Over a period, we have liberalized capital account. We have made it easier for market players to hedge their risks. And then we thought, okay, now is perhaps the right time to introduce currency derivatives where there is no requirement of underlying.
No, taking away from the fact that the real economy has obviously not kept pace with the
financial sector reforms. So we need to align our reforms with the requirements of the real economy.
Fair point, ma'am. But then with respect to currency futures market and OTC markets, I think I have a different perspective. I'll come back with it after the break. Stay with us, don't go away. The Reserve Bank is in a very candid mood, and we're going to get a lot of answers from Mrs. Gopinath.